In today's video, we're going to talk about the fifth interest rate hike we've had this year alone, bringing the interest rate from the Bank of Canada up to 3.25%, which is a 3% increase since the beginning of the year. And the most recent rate hike was 0.75%. If you're new to my channel, my name is Koukun. I'm a real estate investor and I run a real estate team that helps investors buy and sell rental properties. If you're interested in learning more about what we do, this Saturday, we have a investment tour that we're going to showcase a couple of the triplex conversions that our clients have purchased in the city of Welland. I'm going to share a quick clip just about that tour.
Hey guys, Koukun here. We are at a investment property in the city of Welland and we just completed our investment tour. So these investment tours, we take out some of our new clients to check out a few different projects that are either currently under renovation or complete, just to get an idea of the before and afters. We typically go through the numbers on a project like this, sort of purchase price, after repair value, go into the rental numbers if it's already been rented. So if you're interested, click the link below.
So it's almost fully filled up at this point, but if you are interested in joining, check the link in the comments below to see if we can squeeze you in. All right, so today, the fifth rate hike in 2022, as of yesterday, September the 7th, you can see here in this chart, it was hanging around for a while at 0.25%, and since then it's been non-stop increases up to this point that we have a rate of 3.25% at the Bank of Canada level. So that is not the rate you and I pay as consumers. That's the bank rate, and then the prime rate is higher than that. So same information from the previous chart, except in numbers. So the first hike was 0.25 in March, then 0.5 in April, 0.5 in June, 1% in July. That was a big hike, and now still a significant hike. 0.75 is not a small rate hike by any means. A little bit less than the one we had in July, but still culminatively, it brings us to a total of 3%. So why did we have another rate hike? So according to the Bank of Canada's press release, one of the reasons why was the core inflation measures increased from 5 to 5.5% in July. So even though the overall inflation CPI rate did go down, the core measures, so excluding some of the rapid increase and decrease recently with energy, the core measures still increased in July. The good news is that the overall inflation rate, CPI rate, has dropped due to gasoline prices. So it is, as of July, 7.6%, down from 8.1%. So hopefully that is a good trend that continues, because gas prices are do affect most of the other components as well, especially food and many other parts of the CPI index that rely on transportation, right? So hopefully a drop in gasoline prices will seep into the other areas. That's to be seen. The bad news is that the governing council still judges that the policy will need to rise further. So basically they're saying they're not letting up until inflation is really under control. So they're not going to accept, small changes in the CPI data to make more drastic decisions. I think this will be very interesting to watch as we go into 2023, specifically based on how the economy reacts to increasing interest rates, because there are many areas, housing especially, that have dramatically contracted as a result of interest rates rising. And even in their economic update that happened today, the Deputy Bank of Canada Governor did mention that housing was what they expected to contract first, and that is ultimately what happened. Because it is very interest rate sensitive, unlike services, which are not as interest rate sensitive. So again, we'll see if the economy goes into a recession or some dramatic slowdown. It will be curious to see if they can sustain these increases, continue to increase further, or if they will be if they'll be forced to backtrack. So I don't know, but it'll be interesting to watch. How much more, obviously, is the $1 million question. As of this survey that Bloomberg released here, done between August 26th and 31st. So this was before the most recent rate hike. They were estimating, as you can see, an increase to 3.25, which happened, and then a further increase to 3.75. So possibly the October or December interest rate meeting, after which they expect it to flatline and then slowly decline over the course of 2023 and into 2024, and maybe settle at around 2.75%. Again, this is a survey. There's no conclusive information from this, except this is the consensus of the economists in this survey. It is interesting to see, but I wouldn't give too much thought to it, because if inflation does continue further, we can see higher rate hikes. And if the economy slows down or inflation slows down dramatically, we could see a reversal as well. So it is to be seen. That being said, what can you do about it? So if you can't predict where interest rates are going, what can you do to mitigate your risk associated with interest rates? So this is my take on it. You want to have fixed payment you want to fix your payments for variable rate mortgages. If you have variable rate mortgages, and I do, all of my mortgages are variable rate mortgages, you want to ensure that you have fixed payments. The reason for this is it allows you to have staying power. And as long as your payments stay the same, if your income is higher than your payments, even if the interest rate goes up, you can stay in the game long enough for either rents to rise or for interest rates to come down. Whichever happens first, the longer you have in terms of the ability to be patient, it gives you a huge edge when it comes to real estate investing or even owning a home, right? The second option is to pay down higher interest debt. And what I mean by this is even mortgage debt. So if you have, for example, a fixed payment variable rate mortgage and you have just a regular variable rate mortgage, for example, right now, if you were to fix the payments, it's already at the higher interest rate. It may make sense, if you have some spare cash that you don't need for emergency funds, to apply that towards the debt and to pay down. I was looking at the property that I'm going to share in a second here, where the monthly payment as a percentage of the outstanding loan is 6.5%. So even though the interest rate is around 5%, the payment is 6.5%. So by using some of the savings that I have to reduce the loan, I'm essentially getting a 6.5% cash on cash return on that money that I'm paying down the loan with. So something interesting to consider. And if you do have a mortgage that you've had for a while, so if your amortization is down to 20 years or less, and if, for example, you don't have a fixed payment right now and the payments have been going up, it may be worth looking at fixing the payment, but also extending the amortization out to 30 years. Obviously, long term, you'll pay more interest, but in the medium to short term, you can keep your payments low, allowing you to get through these uncertain times. All right, so this is the property that I want to talk to you about. So this is a property I purchased in December, and as of right now, I am under my purchase price, at least in the value of the house. So let me get into some of the details here. I'm just going to quickly show a clip of the actual property. So it's in the city of Fort Erie. It's a 2-bedroom bungalow. Nothing super special, except for this. So the property comes with a piece of land beside it. So this was all in one purchase. All the land between these two houses are one property. And the reason that was valuable is I'm in the process of splitting the land such that I can sell the land separately and sell the house or keep the house. So this allows me to unlock value through the land severance process. So here's how some of the numbers stack up. I purchased it for $550,000. I'm renovating the existing house for about $50,000, putting in new floors, updating the kitchen, bathroom, and doing some cosmetic touch-ups. My initial mortgage was a $440,000 mortgage with a 25-year amortization. It was a variable rate mortgage, prime minus a half, and it had adjusting payments. So as interest rates were going up, the payments were increasing. Here's what I'm going to do to this property. I just am in the process of selling another piece of land. So I'm going to have about 140,000 available after paying taxes and setting aside some money for something else. So I'll have 140,000 left. I'm going to use that to bring the mortgage down. So I'm actually putting more money into this property. Almost the opposite of the burst strategy where you try to pull money out. I'm putting money into this property to reduce the debt of the mortgage down to 300,000. I'm also getting a new mortgage, so I'm refinancing it into a 30-year mortgage. Remember, I started with a 25-year. The rate I'm getting right now is prime minus 0.3. I'm going to ask to see if I can get 0.5, but this is what I'm being offered right now. And I'm going to fix the payments. So moving forward, rates go up, the payments are fixed. The reason I'm doing all of this is, as it stands, the property is a single family home. I bought this property for the land severance potential, but my plan wasn't necessarily to keep this property long term. Now with prices going down, I'm estimating the property itself is probably worth about 440,000. So, so I would be losing money in essence if I were to sell the property. I'm making money on the land, but I'm losing money on the house. So overall, I'd be up positive, but I just don't feel like losing money. So I'm going to keep the property. So by renting it out, I can pay the mortgage, except that the mortgage payment without doing this was going to be about $2,400 a month. And I think I can only get around $2,100 in rent. So after paying property taxes, insurance, property management, I would be deeply negative. By making these changes, I'd probably be able to break even, allowing me to hold on to the property long enough that hopefully prices recover in whatever time it takes, whether it's a year, 5 years, maybe 10 years, but hopefully not that long. And this is how it fits into the real estate investing framework that we have here at Team Koukun. So we want to buy good homes in good neighborhoods. This property is actually in a very good neighborhood, not quite the perfect home, but because of the land severance, it presented an opportunity, and it is still a nice single family home in a good neighborhood. You want to buy properties with a margin of safety. In this case, the land severance portion provided the margin of safety. I was able to buy it essentially at a discount because of the value I'm unlocking through the land severance. I'm now trying to further that margin of safety by putting in more money into this property to bring down my monthly payments such that I can break even. This way I have staying power where my rent can meet my expenses in order to do the third thing, which is to do nothing. And in this case, I do want to sell this property when prices recover sufficiently, but I don't want to be forced to sell at an unopportune time. So by bringing my payments down, renting it out, I can wait and see how the next year, 2 years, 3 years go. And when it makes sense, I will then sell it and hopefully make a profit. All right. Oh, sorry, just this clip again. So hope you found this video helpful. That is in summary, the Bank of Canada rate hikes, some of the comments they made, and what I'm doing about this most recent rate hike specific to the most recent purchase that I made as of December. Again, if you're interested in coming to the Welland Investment Tour this Saturday, link is in the comments below. If you have any questions about the rate hike, mortgage, how the mortgage has affected your monthly payments, definitely check out the mortgage trigger rate video that I released last week, just before this video. And if you have any questions, let me know in the comments below. Until next time, all the best.